Welcome everyone to our 2013 edition of Canadian Banks and our perspectives on the industry. In this year's edition, we have entitled this as the new normal. And what do we mean by the new normal? The Canadian banks in the sector at large find themselves charting a new path as they move forward. This relates to profitability and growth and headwinds on growth moving forward, the ever-changing and increasing demands of consumers and changing demographics in the environment, as well as the constant regulatory change and uncertainty which the sector faces moving forward.
Over the past 5 years, if you look at the ROE environment, it's moved from 21% ROE in 2007 to 17% in 2012. And that sounds like a fairly simple explanation given everything that's happened in the environment, but it's actually when you look behind the numbers and what's been driving some of that ROE change is where I think there's some really interesting insights about the sector.
Banks globally face massive regulatory change, which is consuming significant capital. We're in an environment of limited economic growth with constant changing consumer demands as well as changing demographics. As a result, cost control is critical as banks strive to maintain their results and to offset the drag of this increasing capital requirements on their bottom line.
The speed to which regulators are coming out with new regulations and the impact those will have is of such a vast nature now then treating regulatory change as a change process needs now become something you're doing day to day and actually being baked into how the bank runs itself going forward, which really lends itself to that phrase, the new normal.